que tenemos que vigilar, oportunidades de inversión, por supuesto, y hablamos con Chance Finucane, es Chief Investment Strategist at OXBOW Advisors. Chance, thank you so much for having us a few minutes. Good afternoon from Spain.
Hi, thanks for having me on the show.
I would like to start with equity markets because Microsoft earnings beat expectations, but these strong results were tempered by disappointing guidance for the next quarter. Is this the reason that explains Microsoft stock drop today?
It is. It's the guidance that matters. Investors are forward-looking, and it's not just the next quarter, but really trying to figure out what the rest of the calendar year revenue and earnings growth are going to be. And I think everyone was sort of prepared for some disappointing guidance. It's not just been Microsoft, it's been companies in other sectors as well. But a company as large as Microsoft, it definitely grabs people's attention when you see that they only delivered 2% revenue growth versus the prior year in the most recent quarter, which it's been a long time since growth has been that low. And you're seeing a deceleration in the growth of their cloud business, which is a really big driver for them, but shows that even the fastest growing areas are slowing down at a bit quicker pace than they were previously.
And if we talk about equity markets in general, how are you seeing them this 2023? Because we started the year with a little bit of turbulences, we could say, and of course we are observing all the geopolitical risks, but we are expecting next monetary policy decisions for the Federal Reserve and from the ECB next week. What can we expect, and how equity markets are taking into account all these decisions?
Sure. We would expect that the Federal Reserve will raise interest rates by another 25 basis points. I think everyone expects that. The key for us is that they will continue raising short-term interest rates a little bit at a time, even through May, but they really want to keep the rates higher for longer than I believe investors are anticipating. And that has ramifications for the rest of the economy for the remainder of 2023. And from our analysis, we think that economic growth will continue to slow. You're seeing that impact profit margins, and you're seeing profit growth start to decline versus the previous year. And we think that's going to then carry on into affecting the prices in the equity market. So when the S&P 500 reached $4,000 recently, we think that's too high, and we would expect anywhere around a 20% decline before you start seeing prices really become attractive again.
Where do you expect the Fed announcing a pause in these hikes? Because in the case of Europe, we are seeing how different members are talking about summer. It's a probability, but what about the United States?
They probably will stop either by May or maybe even a little bit earlier. They'll pause at that point somewhere around at a 5% federal funds rate. But the key is, I think everyone's expecting that as soon as they pause, they're going to turn around and start cutting rates again. But that's typically not how things proceed if you look at what's happened historically. And when the Federal Reserve pauses, they tend to stay at that rate for at least 6 months. And so it may not be until the end of this year that you may see them start to cut rates. And typically, when the Fed starts cutting rates, that's an acknowledgement that a recession has really set in and they need to start easing. But if we look back to the last two bear markets that lasted for multiple years, the dot-com bubble from 2000 to 2003, and then the financial crisis from 2007 to 2009, in both cases, the Federal Reserve was cutting interest rates 10, 11, 12 times, and yet could not stop the decline in the stock market. So it may not be as much of a positive as everyone is hoping that, oh, as soon as they cut rates, everything will be fine again and stocks will start going up. We think the slowdown in the economy is going to be a bigger driver and going to bring down stock prices a little bit more than people might hope.
We need to talk about U.S. debt ceiling. I don't know if markets are taking into account the risks, or if are they or not worried, but the US reached its debt limit, forcing the Treasury to engage in extraordinary cash management tactics. There are voices saying that the solution must come from Biden, but what do you think? Which could be the solution?
Well, they've always found a way to raise the debt ceiling eventually. The last time you really had a problem like this was in 2011, and there were other issues going on in the economy, but around that time, you saw stock prices go down by about 20%. You saw long-term Treasury bonds increase in value, so the Treasury yields actually fell. And that would be sort of our view, is continuing to stay defensive in case the government mismanages this raising of the debt ceiling. They have a little bit of time to try and just sort of stretch things out, but we would imagine by May at the latest, they're going to have to put through something to make sure that things continue in an orderly fashion, or you will see more volatility in the markets.
And one last question, Chance. If we talk about equity markets again, which are your main investment opportunities? Where are you focusing in right now?
We would continue to focus on defensive areas of the stock market, or companies that have very high cash flow visibility. So that would be companies like Visa and MasterCard, or O'Reilly Auto Parts in the United States. We also still have a lot of our clients' assets in treasuries, both short-term treasuries and then a little bit in long-term treasury bonds. And that's a way to get a 4% yield for them while still waiting for better valuations that we think will come later in the year. So maintaining a defensive posture and still keeping some liquidity available, because we think prices will become more attractive at some point in 2023. But right now, we're not anxious to put all of that to work.
Thank you so much, Chance Finucane from OXBOW Advisors. Pleasure.
Thank you.
Bueno, pues nosotros nos quedamos con ese análisis internacional y aprovechamos para hacer una